Hello friends and welcome back. You are with Deepak R. Khemani and we are in this 2-minute money and personal finance show. Let's continue where we left off in the previous episode. We were talking about term plans where you pay a small premium for a very large cover. If an event happens, if you die, your nominee gets that full amount. If, however, nothing happens to you in that period, nobody gets anything. So a lot of people felt cheated, saying at least I should get back my money which I had paid. So companies have now come out with a term plan which pays you back all the money which you had paid in that period. These term plans are called term plans with return of premium. What happens? You pay a fixed premium for the period, let's say 20 years. 20 years later, you are still alive. What the company does is, it pays you back all the premiums you had paid. So let's take this example which we were discussing in the previous episode. For a 3 crore policy, a person was paying 50,000 rupees every year for the next 20 years. He has paid an amount of 10 lakh rupees in total. If we take this case of this option, return of premiums paid in this term plan, what will happen is the premiums will go up slightly higher. Instead of 50,000, you will probably end up paying 70,000, maybe even 75,000. But at the end of the term, the 20 years which you had selected, whatever you had paid in these 20 years will be returned back to you if nothing happens to you. These sort of term plans are quite popular amongst people who want at least what they have paid coming back to them after the period. So there are basically two types of term plans. One, the original term plan, in which if you die, your nominee gets the full amount. If you survive, nobody gets anything. And in the return of premium term plans, at the end of the period, if you are alive, you get all what you had paid. Stay tuned for more. We will talk about this and others in the next episode.